Good morning,
Good,
and welcome.
good morning, ladies and gentlemen. No problem, Nicola, thank you. Good morning, ladies and gentlemen, and welcome to the RBG Holdings Introduction to Litigation Finance Investor Presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Just simply type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be made available via your Investor Meet Company dashboard, and we will notify you by email when they're ready for you to review. I would also like to remind you that this presentation is being recorded. Before we begin, we would like to submit the following poll, and if you could give that your attention, we would be most grateful. And I'd now like to hand over to Nicola Forstyn, CEO of RBG Holdings, and Tetsu Ishikawa, Managing Director of Lionfish. Good morning to you both.
Morning, thank you very much. Apologies first, everyone, for the small technical hitches, which were mine, that caused a slight delay to our start this morning. This is our second Investor Meet Company presentation that we've chosen to hold in Q1, and this one is specifically designed to introduce you to litigation finance as we see it. So I'm joined today by Tetsu Ishikawa, who is the Managing Director of Lionfish. I hope that I need little introduction now, having introduced myself a few times to conferences over the last couple of months. But Tetsu is unusual in that he started his career as an investment banker, and when he saw the opportunity that the new asset class litigation finance presented, he's one of the few managers in this industry who's come from an investment banking background and saw this as a real opportunity. And I know that he, in his presentation, will take you through more of why he chose this asset class to concentrate the future of his career in. Just a quick overview of the group to remind those of you that may not have seen a presentation of ours before, that we floated in 2018, having bought out the trading and assets of Rosenblatt, the law firm, the provider of legal services. And then we expanded the group in 2019 with our first acquisition of Convex Capital. And I'll explain a little bit in a minute the rationale behind that acquisition. And then in May 2020, we moved into litigation finance. This litigation finance is to be distinguished from the litigation finance we undertake as Rosenblatt, which again, I will explain the difference between briefly in a minute before I hand over to Tetsu. This year, we've just made a very small acquisition of Adnitor, which is our IT provider, where we're basically bringing in that company to make our IT self-funding. So the idea is that we'll have customers that will buy those services and make profits, for which will mean that our own IT spend is neutral. So just moving on to our strategy since IPO, and then in a minute where we have got to against that strategy. Our strategy is set out when we raised money as profit or acquisition, other legal services offerings that we believed matched our own offering in terms of being entrepreneurial, cash generative, high margin, and commercially focused. Use our expertise to move into litigation finance. Initially, we did that in 2018 by raising money to invest in our own cases, which I'll come on to in a minute, and then moving in 2020 to being able to fund third-party litigation, which is what Lionfish is dedicated to doing. Do selective M&A, which is we did with Convex, and so moving on to how we delivered on that strategy and why. We don't have the delivery slide today. Shows you how many times I've done this. So just going back to why we chose Convex and over maybe another legal services business as our first acquisition. The culture of our business is entrepreneurial. Everything that we do is about entrepreneurism and commercialism. At Rosenblatt, we've always had an entrepreneurial leadership, and we've had entrepreneurial and high net worth clients. Convex was one of our clients, and that is led by a high net worth entrepreneur. It's self-advising entrepreneurs on the sell side of their businesses, often when they haven't thought to sell that business yet. Litigation finance in Lionfish, as you'll come on to hear, is also very entrepreneurial driven, in that we often act for entrepreneurial clients seeking justice or redress and support to do that. If we look at litigation finance and our approach, it is to be conservative in nature and to always be aware of our exposure and our risk. So we are careful to cap at 25% of our revenues the amount of contingent work in progress that we undertake within RBL. And to be clear, contingent work in progress is work where you haven't recovered in cash. And we ensure that 25% of the net assets of the group are the limit of what we invest in external funding. And to date, we have only committed 50% of our funding into our cases within RBL. But in the future, that may change as we seek to keep more of the upside from our investments in-house. Our accounting approach will follow the same conservative approach as we have always adopted. We have had to adopt IFRS 9 in terms of our accounting, but we choose to fair value our investments as close to cash as it's possible to be. This means when we look at some of our investments on the following slide, where we have given indicative outcomes for some of those investments held by RBL, I'm hoping that is on the slide. It is on the next slide. For some of those investments held by RBL, they are not in our market forecasts and they are not marked up in our accounts. They are provided for at cost in our balance sheet, and no revenue is recorded unless received through cash sales for participation rights in those investments or through actual returns received on a settlement or a win. I'm a firm believer that the bread and butter of the business should be developed. The bread and butter profits of the group should be delivered by the other businesses, and we forecast those accordingly. These litigation investments, therefore, remain the icing on our cake, and we would hope to see these bear fruit in 2021 for Neptune, through 2022 and 2023 for Shango and Mercury. And I'll now hand over to Tets to give you a much more in-depth understanding of our third-party litigation finance offering. Thanks, Tets.
Right, so yeah, good morning. Like Nikki said, my name is Tetsu Ishikawa, and we founded Lionfish in May 2020, and I am responsible for running the business. If we just go straight into this presentation, our objective at Lionfish is singular and focused. It's to generate profits from real cash inflows. Now, this may seem an obvious statement to make, but most litigation funding businesses are founded and run by litigators. And if you ever spend any meaningful time around litigators, they're great litigators, but as a breed of professionals, they're not particularly commercial. Now, my background, as Nikki mentioned, is investment banking. I used to structure fixed income derivative and securitization transactions. We're supported by the board of RBG, and in particular, Nikki, who is the ultimate visionary for this business and is an entrepreneur and a very successful entrepreneur. So our priorities as a business are not what most litigators care about, which are typically things such as whether the case is worthy and relevant enough to be reported in the legal press, or whether it's going to set a precedent that changes the landscape of law and so on. Our priority is to generate profits from real cash inflows. I wanted to illustrate on this slide at a high level an overview of the two broad types of funders in the market. Now, the first are the listed funders, and that's in the table on the left. This table hopefully helps set out where we sit and how we contrast to the other listed funders. So first thing you'll notice, we're certainly younger than most of them by quite a long way. But what this really sets out in more detail is how we're all different. Now, as far as we're concerned, the main things to note are, one, we play to our strengths and our investment strategy. So we don't do global litigation, but focus on English and UK law jurisdictions where our strengths lie. We don't do ultra high value or ultra large ticket investments like Burford or LCM, nor do we do high volume, lower value cases like Manolete. And we don't manage external investor money. The second point I'd note is that we report profits, as Nikki's already mentioned, but we report profits not on marking to market, but marking to cash and cash realizations only, which we make possible through our investment sales business model. Now, this point is key because it comes back to our singular objective, which is to generate profits on a cash realization only basis, rather than from marking up investments whose outcomes we can't predict. Now, the second type of funders are the fund managers, who largely operate a typical 220 type hedge fund fee model. Now, in this model, managers usually receive a management fee, usually something like 2% of the funds they manage, and a performance fee, which is usually a share of something like 20% of the returns, but over and above a threshold, so say a 10% IRR threshold. Now, what this means in practice is they have to go for big investments with big upside returns. In other words, what would be referred to as ultra high value claims. And because their overall fund sizes are quite small, the management fee can't support a big operation of expensive lawyers, which is another reason why they have to focus on big ticket investments. And often their fund investors really being the ones who give final sign off, which really makes them more kind of glorified middlemen on, representing and investing monies on behalf of their investors. Now, that means that the margins of some of the traditional funders who are recognized as leading players in the litigation funding market are actually rather quite low. I'm not going to go through the table here, but I think what it shows is that the margins of some of the traditional funders are surprisingly lower than what one would expect, given the amount of money they've raised, the amount of money they've managed, and how long they've been in business for. Moving on to the next slide. To understand our business model, I thought it'd be useful to set out some context in regards to the litigation funding market. Now, the market has grown enormously over the last decade, but the growth has been rather one-dimensional. So originally, it was an asset class which was more suited to Series A venture capital type investing. So high-value cases being chased by a few funders for a spectacular Uber-esque return. But 10 years on, and most of these funders haven't really evolved their business models. They're still raising monies largely from institutional investors on the promise of high returns to be generated from the same kind of ultra high value cases. And this has created an oversupply of money focused on those high value claims where there is simply not enough deal flow, which is why many of the traditional funders are now spending more and more time and resources trying to originate and develop high value claims that they can then invest in. Now, the solution would be for them to go to more normal size claims, but many of these funders can't because they need these ultra high value claims to make their performance fees and business models work. Yet the reality in the litigation world is most cases are not ultra high value. In fact, they're the rare ones. There are over 5,000 commercial litigation solicitors in the UK alone, and it's just the reality that most are not working on ultra high value claims. Now, obviously, we can't fund too small a case either, but the £2 million to £50 million claims, which are too small for some of the funders, is where we think the most attractive part of the market is, because there are more of them, and arguably, these claims actually have better risk profiles. And to just make that point in very simple terms, just imagine a £30 million claim on the one hand and a £3 billion claim on the other against a big multinational. That multinational is going to defend a £3 billion claim far more rigorously than a £30 million claim. And the other point to note here, though, is that as principal investors, where we are investing our own money as opposed to money on behalf of investors, we actually keep all the returns we make rather than trying to scrape off a performance fee from the returns as our base revenue. So this means we don't need ultra high value claims because we can actually make these £2 million to £50 million claims work for us commercially in a way that many other funders can't. And we can therefore price more competitively as well in the marketplace to win more business. So as a result, we focus on a different part of the market from a lot of the other funders who tend to play higher up the claim value chain. We are more focused on the £2 million to £50 million claim area. Moving on to the next slide, I wanted to touch on Islero quickly because we launched this as an insolvency offering in July last year, and I think there have been quite a few questions on this. Firstly, avid followers of Spanish bullfighting will know that Islero is the name of a famous Muir that killed the matador Manilé. So logically, many have seen the Islero offering as our attempt to take Manilé head on. Actually, Islero is just one part of achieving our singular objective at Lionfish, which is to generate profits from real cash inflows. Now, what Islero does is it gives us a presence in the insolvency market to generate good investment opportunities for us. In fact, the choice of name was simply to take advantage of the great brand recognition that Manolete has spent 12 years developing. But this doesn't mean we're trying to be like Manolete. Now, you may have noticed on the earlier slide that Manolete had 5.3 million across 218 deals committed, and I think there's a more up-to-date numbers now available from Manolete. But whereas they had 5.3 million across 218 deals, we had 4.9 million across 7 deals. In other words, we go after large claims because we believe they have better risk-adjusted return profiles, and they are often the ones that liquidators don't make available for assignment because there is too much value in the case for them to simply give away for a small sale proceed up front. Now, we've attempted to show this on the illustrative table on the left-hand side of the slide. And I want to explain what we really mean by this, because some might interpret this and say, well, a more developed case means it's closer to trial and therefore more risky. And now that point's not lost on us at all. In fact, we actually come on to that very point later on in the presentation. But the key distinction here is that on cases which are usually for assignments, liquidators are looking to generate cash inflow into the estate by selling it for an upfront amount to a funder. So that means their focus is not on the merits of the case, but to drive cash flow into the estate, as is their obligation to do so. But for the funder, that means there are greater variables and uncertainties, which in our mind means greater risk. Whereas on the larger claims, which usually come for funding rather than assignments, the liquidator has recognized the value in that case and often invested time and resources, maybe possibly even cash, without much in the way of return. And often these cases come with a barrister's opinion or maybe even a QC's opinion on the prospects of success, and they also have a well-defined litigation strategy. So that doesn't mean the case is close to trial, because this could all be done before proceedings are even issued. But it does mean we have a lot more information to base our investment decision on than in a typical assignment scenario. Now, to be clear, it's not to say that riskier early stage assignment cases don't work, because Manolete seem to have made it work. But this strategy requires scale, volume, and market share, which is what Manolete is set up for, but we're not. One final point I'd make is that this also explains why commercial litigation funders like Lionfish are far less sensitive to volumes and more focused on value. So our priorities with Islero is not to give some PR-pleasing figures on deals closed, but as a means to accessing the kind of attractive investments that Lionfish ultimately wants to be making. So on this slide, I wanted to explain how we position the business within the broader litigation funding market. I mean, in short, we present ourselves as a fresh new generation funder. Now, that's obviously a cliche, but in a market which is quite slow, and has been very slow actually to evolve its practices and structures, it's quite an impactful message at the retail level. When a claimant or a lawyer goes to a traditional funder at the moment, they're all largely faced with the same pricing, same structure, same onerous process. We want to be a must-go-to alternative, and we do this by focusing on things that litigators are actually quite poor at, so namely the customer service principles of speed, efficiency, competitive pricing, transparency, delivery. The boxes here on this slide show how we view each step of the process that we run as being key to reinforcing what we believe, and we back this up with various thought leadership pieces in the specialist legal press, all of which are designed to show that we think, view, and articulate things differently to other funders. Just this morning, we also announced that we have made our litigation funding documentation publicly and freely available, because it's part of the drive to create a more transparent, credible marketplace. And that's the kind of initiative that I think we want to present in the market and ultimately drives business to us, because we are seen as a must-go-to alternative to the current swathe of funders in the market. Now, I won't go through each one of these boxes on the slide, but ultimately the underlying theme, what this really reflects is a trading floor-like sense of urgency that doesn't really exist in this otherwise slow market. And that's how we position ourselves in the retail side. Right. So pricing. We wanted to touch on pricing because it's quite an interesting area and one that's not particularly understood, including by many of the litigator-run funds. The litigation funding market started with a Series A venture capital type investment mindset. So an investment for X% of the equity, or in a litigation case, a share of the award. And the market quickly evolved to include a minimum return, so that standard pricing structures became usually what I call the greater of. So the greater of a minimum multiple, usually 3 times, or a share of the award, usually 30% of the damages. Now, with our pricing, the returns are not linked to the claim value, and instead, it's linked to committed capital and time. Now, the significance of this is that by doing this, we're potentially foregoing massive upside, but in return, getting a fixed return. This may seem counterintuitive, but the premise of this is that claim values ultimately recovered in litigation cases are often far less than what one expects at the outset. So it's not uncommon for a claim to come in to us where the headline claim value is an astronomical number, say £500 million. But when one does a sensible commercial and non-legal assessment of the case, it's probably more like a £25 million claim. Now, all we're saying is people can fantasize about their 500 million number as much as they like, but we'll just focus on the worst case scenario and make sure we can make a decent return. And if we're right about the 25 million pounds, then we will make more money because our fixed return pricing on 25 million pounds may be less than a 30% share of 500 million pounds, but it will almost certainly be more than a 30% share of a 25 million pound outcome. So is this conjecture? Is this or words? The answer is no. To test this hypothesis, we're rather fortunate because Burford published their investment data on their website, and the latest one I think available for download is up to June 2020. Now, I'd add that if you print it out, you'd need magnifying glasses to read it. I mean, it's they're very, very small font in a PDF that's virtually impossible to read, but we donned our monocles, we manually typed it out and overlaid the principles of our pricing model based on the information provided in their data. And the results are summarized on the table on the right-hand side, showing that our pricing performs better. In fact, what it shows is precisely the point that I just made, which is that ultimate recovered claim values are lower, and this is fed through into the performance comparison. Now, to highlight some key data points in this data set, there are 300 investments which Burford have made from the very beginning to June 2020, of which 139 had concluded. Now, of those, only 16 investments, according to their data, generated returns greater than 2 times invested capital. And only 5 investments generated returns greater than 3 times invested capital. And this is in a pricing model where the minimum is supposed to be a minimum return of 3 times. So in other words, we're often more at the 25 million pound end in my example than at the 500 million pound end. So what are the key benefits of pricing it linked to time and committed capital? Well, 1, we believe our pricing generates better returns. 2, we believe it helps us win business because of this optical arbitrage that it makes our pricing look cheaper at the beginning of the litigation when people are looking at that 500 million pound top end figure instead of the more realistic 25 million pound figure. And 3, it makes smaller cases more viable because it doesn't rely on claim values reaching a certain threshold. And this in turn generates more opportunity for us and therefore in turn generates more portfolio diversification. But most importantly, and this comes back to a point that I referred to earlier when talking about Islero, and we believe this kind of pricing model actually fits better with the risk profile of an average litigation. Now, what I've tried to show here on the chart on the right, it's just an illustrative chart, but it's to set out the basic principles of the risk profile of a litigation case versus a simple option contract. If you take a simple option, all factors remaining the same, the risk of an option diminishes as the underlying option tends to maturity. Now, in litigation, the risk of the case at the outset is high, but once all the pleadings have been made and disclosure of evidence has been done, but before it goes to trial, the risk dips Now, if it goes ahead to trial, this risk picks up considerably because there is just greater risk, greater variabilities at trial. So things like the judge's view, what side of the bed does the judge wake up on that morning, the quantum, the recoverability, the enforceability issues of the judgment, so on. Is there a risk of appeal? And there are quite a few other risks that factor in to varying degrees. So before trial, we're at this, we have this dip in risk, which is the best time to settle. Now, the downside, of course, of any settlement at that stage is that any settlement value will be at a significant discount to the hoped for expected value. But because we have delinked from the claim value, from the settlement amount, we actually encourage settlement by making it a much more viable option, something which we wouldn't be able to do if we were incentivized to maximize the claim value, which in turn is to maximize our performance fees, which means then we want to encourage it to go to trial, which means taking on more risk. So we have a different view on this. And hopefully what this shows is that when we price, because we're structured the way we are, we really focus on risk and value, and that and ultimately how that then leads through to generating profits from real cash inflows. So hopefully all that has kind of helped set the context of the market we operate in and the way we view the market and the way we play in the market. I thought I'd conclude with a slide that just sets out our operating objectives for the next 3 years. As we've said from the outset, our motivations in the market are not to be the most prestigious funder in the eyes of litigators or associated with precedent-setting legal cases to which we might leave a legacy, but it doesn't really meet the purpose of what we're trying to achieve as a business. The table on the right sets out the approximate kind of cases we'll be looking to invest in. But our motivations are and always will remain to achieve that singular and focused objective of generating profits through real cash inflows. And to do that, we have 3 key operating objectives. The first is to build and maintain our market position. Now, last year, in 8 months, we had 240 inquiries. The flow of litigation cases isn't always regular, and in my experience over the last 10 years, the number and quality of inquiries can oscillate quite considerably. But the key is to make sure we're receiving as many inquiries as available in the marketplace from which we can pick good investments, and we can do that through maintaining prominent and relevant position and presence in the marketplace. Objective 2, maintain a very robust and rigorous underwriting process. Last year, of the cases that we completed assessments on, we rejected 96.1% of cases. We're not a fund. We don't have an investor pushing us to deploy monies. And that lack of pressure to deploy, which other funders have, means that we can actually continue and will always continue to be highly selective and not afraid to reject investments where we think the risks far outweigh or even slightly outweigh the return potential. And lastly, it's to maintain strong operating margins. The concept of operating margins being something you probably wouldn't hear a litigator talk much about. But as a business, we have a small team, but one that is able to process a lot very efficiently and rigorously. Now, we are and will remain very focused on driving operational efficiencies through technology and systems, as well as through our mutually beneficial and operational efficient relationship with Rosenblatt. And if we can maintain these 3 key operating objectives, it'll help us achieve that singular objective that I keep on coming back to of generating profits from real cash inflows. Thank you.
Tets, thank you very, very much indeed. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a few moments to review the investor questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your dashboard on the Investor Meet Company platform. I'd also like to remind you that your feedback is important to the company, and immediately after the presentation has ended, you'll be redirected for the opportunity to provide feedback in order that the company can better understand your views and expectations. Nicola, I know, and Tets, I know I haven't given you an awful lot of time, but if I could ask you to just have a look at the Q&A tab, if I could ask you to read out the questions and perhaps who it's from and give a response where it's appropriate to do so, and then I'll pick up from you at the end. Thank you very much indeed.
Thanks very much. And Tets, I'll manage this process for us both and hand over to you. So, Steve, I want to thank you for your initial question because it did make me chuckle. He did initially ask, are you actually after Manalay's lunch, as you've indicated prior? And obviously we did somewhat address that in the presentation. But just to be clear, I'm after everyone's lunch. And if anyone leaves any lunch out, I'll be making sure we take it. So just to clarify that. But you went on to ask, could we comment on the length of a typical settlement versus actual payment being received in cash by the company? So Tex, will you take that one?
Okay, so litigation cases are often very unpredictable in terms of process, but obviously from the outset we can assess what we believe should be the length of it due to the complexity and the nature of the defendant and all those kind of elements of both legal and financial experience that come in. Generally, we don't tend to go for anything where we think the risk of a case is going to go more beyond 3 years, but we also tend to go for the cases where we think there's a good chance of settling earlier. What is that expectation on length? I mean, we don't, it changes from case to case, but that's, I've given you the kind of the maximum end. What I would say is that in my previous experience running an after the event insurer, which is a litigation insurance business, so it looks at the same metrics and the same types of cases. We used to have expectations between 18 and 24 months of cases from policy inception to settling. And so that's the kind of framework that we're typically working to.
Great. And Simon asks, how competitive is the process of winning new claims?
So the market is quite competitive, but one of the key advantages that we have is we're actually commercial. A lot of litigators a lot of litigation funding businesses are unbelievably slow. So even without pricing factored in, if we're efficient and quick, and actually, well, rather than quick, we're actually communicative and we explain where we are. It goes a long way to winning business because a lot of people then place confidence in us. And one of the things about investing in litigation is it's not just about the initial bit, it's about what happens once you've started investing and what they're really looking for, in the same way that we're assessing all claimants and law firms in terms of what the working relationship will be once they've had our money. They're looking at us to see what we're going to be like once we've given them their money. So the process of winning is psychologically probably a lot more nuanced than just putting up a price and hoping your 1p discount will win the business. It really is a process and a matter of building a relationship, and I think we do very well on that score.
And I can probably add some colour to that, because I was a client originally, and one of the reasons I targeted and headhunted Tex to run our business is that when he was at Sparkle and Acasta, he was always incredibly responsive, very quick, and chasing us down for that meeting. So that definitely works. I speak from experience. Alan has asked, the proposed returns are contingent on achieving 85% success rate. I believe this is above Burford, who are experts in the field, with highly paid experts and 10 years experience. Why do you believe you can achieve 85%? We run the 85% success rate on our models because of Rosenblatt's success rate. And Rosenblatt has been in the business of doing litigation for 30 years. And Rosenblatt's own success rate across those cases that it took on risk, that's on risk, not where we were paid by our clients to fight their case for them, but where we took the matter on risk ourselves and did it on a no-win, no-fee. We've had an 85% success rate across all of our cases during the 30 years that we've been in business. Moving on to Atif, and apologies if I didn't say that correctly. How do we source business for Lionfish? I think Tex has covered that largely in his presentation. And how large is the market segment we are targeting? And which competitor do we admire most?
That's a good third question. Okay, in order, how do we source business for Lionfish? So litigation cases are kind of like, a select few kind of types of fish in a rather big ocean, but there are a number of ways of channeling that. So I would say broadly 2 ways. One is through an active broker market, and there are actually brokers, and quite a lot of them, who specialize in this area. And we see them as quite an efficient source of accessing cases. Some litigators turn their nose up to them because, well, they're brokers and not lawyers. But we actually think they're very handy and they're very useful, and we have very good relationships with them all. The second one, which I touched on in the presentation, is just by being there and having a prominent market positioning in terms of how we operate, and being this kind of must-go-to alternative. People do come to us directly as well. And these can be through word of mouth. Sometimes they just come to us through referrals, or through just seeing my name. I mean, I do get probably at least once or twice a month a totally unsolicited approach from a litigant. So it's really quite varied, but it's usually through leveraging other people's infrastructure or through making sure that we are prominent in the marketplace, and cementing our position as a Moscow alternative. Your second question: how large is the market for the segment that we are targeting? So there are two parts of this question. The first one is it's slightly undefined, because obviously we can never really tell how much cases are going to be there. And obviously it's not just the fact the case is there, but it's got to be a case which is developed, and it's got to be a case that has a strategy and has good prospects and recoverability and quite a lot of other things as well. So by the time you've filtered through, I mean, the original marketplace is quite large. I mean, there are over 5,000 commercial litigation lawyers. There are God knows how many barristers, and that's just in the UK. And then you broaden that out, and God, I mean, there are a lot of people being kept employed by litigation. But ultimately, how much of that filters through to cases, it's hard to say. But I would say that the run rate that we hit last year, about 30 inquiries a month, is a good run rate. And hopefully we can improve it more. But the natural quality cases will generally tend to find their way to us. The second part of that, though, is the fact that although I talk about these £2 to £50 million claims, the other thing that we can do, it's not always the fact that because a case is 150 million that it doesn't fit the other parameters. Sometimes you can have a very large claim, but it fits all the parameters that we want. So it's a relatively straightforward case in terms of the legal arguments, and it's also something that can be that is actually otherwise very fundable. And we tend to work quite well with both insurers and other funders where required, or where possible, to take slices of risk, but we'll structure it in our way, in our positioning. And the other great thing about not actually linking to claim values is that other funders then don't feel as threatened with us as they do with others. So we're not fighting over the same cake, and that means that there are more opportunities there that we can create, and that's a developing part. Where funders may look at larger cases and begin to work together. So there's quite a lot of opportunity there. Which competitor do you most admire, and why? I think I might be shot if I said I admire any of them. But in the whole, I mean, from a legal perspective, I mean, they are some of the best brilliant legal brains in the business, and I have a huge admiration for them. But in terms of operations, it's very hard to say, because it's quite an opaque market, and I think we're trying to drive that push to being transparent and saying this is how we operate and this is how we want to look at risks. And I think, without meaning to skirt your question, I think it's very hard to say without knowing how they really all operate, and the nuances of their operational activities.
I think it's fair to say, for my part, that Burford set an incredible, blazed a trail of litigation funding on the public market, and there's no question their business model has been hugely successful. I think that somehow, though, it has got a little bit out of kilter with what the reality of the funding market is today. Just moving on to a question from Abby, and we've got quite a lot of questions text, so we're going to keep the answers a little tighter than maybe. It's me being polite. I'm normally not quite so polite when I'm chatting with text on our calls, am I? About the length of your answers. Abby asked if we could just tell her a little bit about Lionfish's staff, diversity of roles, and how many claims we're capable of working on, and how we may scale this.
Right. So part of the way that Lionfish is set up is it has this relationship with Rosenblatt. So at the pure Lionfish level, we have 3 dedicated staff, who are spread between an experienced solicitor who helps oversee and manage and also kind of underwrites the investments that we make to some degree. And we also have a very key operational person who has been part of the broader group for many years. But obviously we also interact very, very closely with Rosenblatt and quite the rather strong dispute resolution team there. So there's quite a lot that we leverage across as a group in order to be able to bring the value to Lionfish. And through that, we get quite a lot of diversity, both in terms of roles and personnel as well.
And David asks, have we contracted any cases on the basis of our new pricing plan? I think the pricing plan isn't new, it's been the only pricing plan. Is that correct?
Correct, yes.
Yeah. And Atif asks again, do we expect to see consolidation in the litigation funding market?
Or I My personal opinion is probably no, just because there are quite a lot of egos in the market. Litigators tend to have rather big egos, so I wouldn't expect so. But that's just my personal view. Sorry.
Yes, I think I share it. I don't see it happening in the same way that maybe it might not. I don't see much more coming onto the public market, if I'm honest. And I think that's to do with the way in which funding is arrived at. And there's a lot of private money looking to get into the sector. So I don't think we'll see much more on the public market. Jeremy asks, if we reject 96% of cases, won't parties not bother submitting proposals?
No, they won't. Sorry. The answer is they will always submit proposals because lawyers are under an SRA obligation to make sure that they make funding options available to their clients. But more importantly, it's the fact that it's the way of unlocking work. So, I mean, in the same way that you'll if you're buying a house, you'll apply to as many mortgage companies as you want, so that you have options. So will they. What they really appreciate is a quick no. And actually, most of them are not not blind to the reasons as to why you say no. So if you say no very quickly, they actually want to come back to you again, rather than someone who strings it out for 9 months to then tell you a no that you could have said 9 months previously.
And Roger says he's not clear on the distinction between Islero and lionfish. And I think my answer would be that it's like lionfish is Cadbury's and Islero is the 12 bar. But maybe you have a slightly better way of putting it, Teds.
No, I like that. I mean, Islero is a product, is part of the strategy within lionfish. So Islero is a kind of a sub brand that plays in that market space to ultimately work for the benefit of lionfish.
And Sarah asks, how do the cases find their way to lionfish? Is it through brokers?
Yeah, we touched on this before, but yes, it's predominantly through brokers and direct approaches. But because the market, the underlying cases are all very different, we're also trying to capture a net quite vast, so that litigants can approach us directly, barristers can approach us directly, sometimes just relationships and contacts that I've had from the past or from banking or commercial finance brokers. It doesn't really matter. I mean, a case is a case. The question is, once it comes to us, how quickly we process it.
Great. And Mark asks, but Burford Capital share price has fluctuated wildly, and does lionfish being part of RBG mean that our share price will be volatile? I don't think so. In 2020, we're expecting a small percentage of our profits to have been generated by our litigation investments in lionfish. We don't expect that lionfish's returns will ever exceed over half of our profits. So I can't see a situation where we will be directly compared to Burford. We're also adopting a far more conservative accounting policy than they do. We are being very, very prudent, and therefore we're not going to be, I think, subject, famous last words, but we shouldn't be subject to the same kind of investigative attacks that they have seen and that Manolete have also unfortunately been subjected to. I think I would be happy and to be and want to be transparent in our accounting, and I'm very happy for that to be reviewed by anybody and happy to answer questions on it. I think that it's a very conservative way of doing things. Emmanuel is asking, how efficient is the tax structure on litigation finance? Jersey, Isle of Man structures or UK onshore, could that change in light of pressure the UK has on public finance? We're operating obviously within a UK structure. We don't have an offshore structure that we operate our investments through. We do sell, when we sell down our investments, we sell them down to an offshore structure for our investor clients, but our business is entirely UK and cut by the UK tax net, and as such will be affected if there are corporation tax changes today. We're not a fund, so I don't think it really applies to us in terms of where we should be onshore or offshore. And we looked at that quite closely when we set up lionfish. What do you see as your capacity in terms of number of cases? Comes from David.
Right. So very good question. We have we have a very, very clear and quite methodical process bordering on OCD. I mean, we have a process written through which also filter into Rosenblatt, and with the back with the kind of the overriding support of Rosenblatt's dispute resolution team, where we focus on available resources, or it's not really for me to say, but available resources and expertise as well, tapping in. I mean, we can actually process quite a lot of cases at any one time. In terms of the process that goes through, I mean, like I said, we're probably getting through on average 30 cases. I mean, I think we could probably take close to double that if required. But the key is, and one of the key kind of internal mental KPIs I have, is always making sure that we spend as little time as possible on cases we're ultimately not going to fund. So a lot of cases are going to be rejected. So let's just get to that no quickly if we're going to reject it. And that is really the thing that allows us to assess and concentrate our time and efforts on the investments that we may end up making.
And David also asked, if we sell a stake in a claim, won't that then require fair value accounting in the profit and loss and balance sheet? And yes, it absolutely does, but we're effectively marking to market. So the fact that we have sold an investment for that price and management takes the view that that is the value of the investment, and that the cash element we have released is effectively the value into the P&L at that date. We also look at the investment we've made in that investment, and if we have sold 25 or 50% of that investment, we will take 25 or 50% of the invested cost into our P&L as well. So it continues to be very prudent. David also asked, are we primarily targeting the larger no-win, no-fee space? And I assume this is a question for the group, because look, that's all Lionfish does. As a group, we're very lucky in that if a client walks through the door of Rosenblatt and says, I've got a brilliant case and I want you to run it and I want you to fund it, and we don't think it is a brilliant case, we can either say completely no, or we can say no, but you can pay us and we'll still run your case. Or we can say we're not prepared to fund it, but we will go and get you litigation funding externally to both Rosenblatt and Lionfish. So what's great about our group is, as a client reaches us, we really are one-stop shopping. We can handle this situation, whichever route needs to be taken for that. And in fact, Tets has often received claims that don't yet have law firm representation, which he's able to then introduce us, and we compete competitively against our competitors for that. So we still need to tender, and we still need to obtain the work in the same way that any other law firm would need to obtain it. I think moving back to Alan asked, I believe the consensus forecast for RBG is assuming around 3 million of revenue for Lionfish this year. Does that forecast require a number of successful resolutions or outcomes to our investments in order for that to happen? And the answer is no. That is assuming a level of sell-down participation rights in the period. And Jeremy asked, who would be the main players in the litigation funding market outside of the quoted sector and fund managers you list?
They would actually probably be the traditional institutional investors, and I think this is actually one of the, in my personal opinion, one of the interesting trends that we may observe over the next few years. The institutional investors who are currently giving money to litigation funders to invest in the space are also learning more about the underlying market. So what you're beginning to see increasingly are certain hedge funds who are beginning to invest directly and actually compete directly with the funds that they are investing. I mean, there's one particular hedge fund who I think has given money to about 4 or 5 different funds. And not only do they all compete with each other, the litigation funds, but they also compete with the hedge fund. And so it's quite an unusual business. But I think from our market perspective, where we sit, hedge funds will ultimately still compete in the bigger space. I mean, it's too much work for too small an investment for them to be operating where we are. So we'll always have that, that kind of level of protection as far as our business is concerned.
Thanks, Tets. And Steve asked, would you take external money into Lionfish on a management performance fee over a hurdle basis? Steve, we're not intending to become a fund. We don't think a fund suits this asset class because it puts pressure on deployment and investment into cases that are maybe not suitable for investment. However, we're always looking at how we're going to evolve and build and scale our businesses, and Lionfish is reliant on RBG's balance sheet. And therefore, the next stage of the evolution of Lionfish will inevitably be to look at how we could partner up and scale up with additional funding. But will that be on a managed performance basis? I very much doubt it. And Tets, I think you would agree with that.
Absolutely, yes. The important point is that we can never be under pressure to deploy, because that is bad news as far as I'm concerned to everyone involved. It's not good for the market. It's not good for the solicitors. It's not good for investors. It's not good for shareholders.
Right. And Alan, one last question. I think we're bordering on our time limit. When you part sell down an investment, who are our typical buyers or investors? They are high net worth clients. I'm a high net worth myself, and I have relationships with people who've worked in the high net worth industry or work with investors. And we actually use a consultant contractor who manages those relationships and finds high net worth investors for us, because there is obviously a lot of interest. There's been a lot of interest generated as a result of the returns people have read about, even in the Sunday newspapers, that could be generated and have been generated in the past, thanks to largely Burford's marketing efforts. And therefore, there's a lot of interest in investing in this asset class. So for us, it was effectively should be looked at as seed capital. It's a way of getting our business off the ground and leveraging our balance sheet potential, but still enabling us to grow faster than our own balance sheet will allow. I don't see any more questions or questions that I have not answered. Could I just make one comment before I hand back to the host? And that is to say, we are looking to run as transparent a business as possible. We are on the public market. We have no problems answering questions. Please feel free to email either Tets or myself from our email addresses on our websites if you have any further questions in the future. Many thanks.
Nicola, Tets, thank you very, very much indeed. And as I say, I think you have answered all the questions that were submitted by investors, and we have missed any out. Obviously, we'll make them available for you to review. And to the investors, thank you very much indeed for posing those questions. And of course, we'll notify you when they're ready for you to review. Could I please ask investors now not to close this session, as we will now automatically redirect you for the opportunity to provide feedback. If you access this meeting via our website, then the feedback page will automatically appear. But if you access this meeting via the link sent you by email, then you'll be simply asked to log back in and submit your feedback. And if you could, that would be very well received by the company. On behalf of the management team of RBG Holdings, I'd like to thank you very much for attending today's presentation. That now concludes today's session. Good afternoon, and thank you for your time today.